Good evening, everyone. We are live from Chicago, and it's Thursday, December 14th. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are glad you are with us tonight on the final episode for 2023. We're going to look at the wrap-up for the year, what's happened, and then look ahead to what could possibly happen, more like what could possibly not happen in 2024. If you're new to the program, please subscribe to us on YouTube. Click the little bell and you'll get an update every time we go live or we post a pre-recorded video. I also tweet every single day, and I'm going to try to change that in my vocabulary because I guess I'm not supposed to be tweeting. I'm supposed to be Xing or something, but we still tweet to X and to Facebook and to LinkedIn, and you can find us there most every day. We cover a variety of segments. These are the 12. We're narrowing it down tonight because I really want to focus especially on 3 of them. because I think it's important that you understand what has happened here in the last couple months and how that could affect us going forward. So the monthly review and the yearly review, the stock market rally really means that investors are discounting that the Fed has beaten inflation without causing a recession, achieving a so-called soft landing. So what does a soft landing mean? Well, imagine the last time you were on an airplane and they said, wind's pretty bad here. You better brace yourselves for the landing. And at the end of the landing, there were maybe 4 or 5 teeth loose in the aisle. That is a hard landing. Now, the metaphoric equivalent to that economically is that the Fed manages to kill inflation, but sends hundreds of thousands of businesses out of business. And the unemployment rate goes up to way over 5 or 6%, maybe not 10, but way high. But hey, we stopped inflation. A soft landing is kind of where we hope we are right now. So we had a second high today in the Dow. So we've had 2 lifetime highs back to back, but it's not the same for the S&P. So the biggest sector in the S&P 500 is technology, and it's garnered the majority of new inflows. Look at that spike there in April. So that's new cash going into the technology sector, and a lot of that is going into what's known as the Magnificent Seven. And you guys have heard me talk about that in last month's show. Go back and review that. We actually have a program now that focuses on the Mag 7 and AI. I'll talk more about that at the January show, the fireside chat there, okay? So according to Dow Jones, only 16 trading days it took to eclipse this last correction. All right, the quickest clip that's a tough thing to say, quickest clip in a decade. One of the shortest comebacks since the 1970s. So if you look at these little bars, you want shorter bars, not big ones. 1970 was the number of days, about 230 days it took. That's trading days. So that's more than a year to get back out of a correction. That doesn't mean a new market high, just to get out of the correction. All right, but this was a really snapback occasion here. And for the most part, that's good. Although if you are putting in protective stops and you have a strategy that does that, it's hard to keep up with the S&P 500, and I'll talk about that in a few slides. The S&P is not at a lifetime high, and neither is the Russell. And yet, the Russell, here as we finish 2023, had a 3.5 increase day yesterday, 2.5% today, that's 6%. But what's the reality here? Well, the S&P looks like it's soon going to hit a new record, but small caps, that's the Russell, are still 20% below their all-time high. So it is this bifurcation, and that's one of my words of the day. It won't be today because I have a new word of the day today. But bifurcation happens when you have entities, in this case Dow, S&P, NASDAQ, Russell, that are not necessarily moving in sync. You want in a strong bull market to see all the major indices moving in sync, and we do not have that, and it definitely did not happen today. It looked like we were off to the races to hit new records again, and then the NASDAQ was down 180 points at one time. It actually came back and closed positive, but that's the sort of volatility you have when we are approaching market highs, because the bears get empowered to say they can't get through it, they meaning the bulls, and they go in and start shorting. So that's what we're facing here in 2023. Now, here's another thing. You've heard me say the Magnificent Seven and these multi-trillion-dollar companies are driving a lot of the returns here in 2023. That's one of the stories of 2023. Never have so few stocks made so much money for so many people. That's a phrase you want to kind of pay attention to. Why? Because there are plenty of other sectors that are not participating. One of them is healthcare. Pfizer, huge company, although not in the trillion-dollar category, fell 6.7%, their lowest close in more than 9 years after they said revenue could suffer next year. So this is the takeaway that I want you guys to have on 2023. It is much easier to make money in the market when all the sectors are participating. The VIX is low, the volatility is low, but that's not the way this year has been, and that's why it's caused us to put some protective stops in. Again, I'm going to show you this on the graph, because some of you have called and said, so it looks like we're having a decent year, but not a phenomenal year. What's up with that? So we're going to talk about that. And here it is. So what you're seeing on this chart, you'll see this is the S&P 500 in the upper left-hand corner. You see the months at the bottom. Each bar or candle, in this case, that's what they're called, represents 1 week. So we started the year off. You can see 2023 there, okay, the lower left-hand corner. We started off and market's moving up, and that's good. And then we hit that red square. So when that happens, we have protective measures in place so that if a 2008 were to be in progress, because we can't predict the future, we have to raise some cash, and that is what we did. But as you can see, the market turned right around, and then when the green block that you see there happens in the second week of April, we're back to being fully invested again, and then the market just continues on up until we get to August. When we get to August, you'll see the red bar going down, but we're still in the channel. All right, and then you see a red bar that almost goes through the bottom side of the channel, but then continues back up. So this is what we monitor as portfolio managers. Where is strength, which is the top of that channel? Where is weakness? If we are entering a period of weakness and price, as represented by those candles, busts through the bottom of those channels, 1 or 2, or especially 3, we have to raise cash. Because we cannot take a chance with your money that we could have another 2008, especially because there are so many geopolitical and economic issues facing us right now. Now, you've heard me say how resilient the market has been this year in the face of, for one war, and then a second war, and then both of the major presidential candidates now with major legal problems, which we'll talk about in the next segment. All right, actually the segment after the one next. But so we avoided going through that. So I did not raise any cash. The market continued up. And then you see the next red block. That's halfway through September, and we raised cash. And then the market continued to go down. You can see hitting its low in the third week of October. Now at that point, where that lowest red bar of the year is, we were about 55% cash in CG and about 30 in GI. Okay, that was the proper strategy had the market continued. So you might be saying, well, I don't really want you to take those protective risks. I'll just stay in the market no matter what. Well, we have programs for that. I introduced that last month. Go back and watch that video. You can see how that program works. I'll be talking extensively about all 4 programs at the January Fireside Chat. All right, but for now, we had to take our strategy, which was to raise cash, and then you see that huge green bar at the end of October, and then going into November, and then the green block there means, okay, at that point, I have to be fully 100% invested, which we are, and we have been for a month, if you count the blocks there, 1, 2, 3, 4, and this week is, it's been a really good period, but what it does mean is we have to protect your money by having those kinds of strategies. Now, it only happened twice during the year, but that's enough to hurt performance to say 7 to 9%, depending on how we shake out this year. When the majority of our clients were in their 30s and early 40s, it's different because you have a longer amount of time to recover. But as we have all aged, and if you're watching the show as a 30-year-old, you probably don't want to be in a program that has this kind of risk management, unless you're just happy, if you are happy just seeing your account go up and down 40 to 50% in these terrible bear market years, but you've got 30 years to recover. Most of the people that are clients of mine do not have that kind of time, and so these strategies make sense for the majority of their assets. I trade and other clients trade programs that have no stops, no money management whatsoever. We're just in there, all right? And then we have challenges with that too, but it's with a much smaller amount of money. So go back and watch last month's video and you'll see how that works. This is encouraging. This is the last time I'm going to show you third quarter earnings. This, of course, is the fourth quarter, which means when I come back to you in January, we'll be talking about fourth quarter earnings. Those of you that have been seasoned pros on this show, you know that the S&P 500 above expectation percentage average is 73%. All right, 73%. We are at 82. Consumer discretionary, 83. Staples, 84. Technology, 91. Communication services, 89%. These are really, really strong numbers. When you have these kind of earnings report, if you have a Fed that is not menacing, you're going to have a bull market. And a long one, as long as these earnings keep being reported the way they are, and companies exceeding what they predicted the month or the quarter before. All right, makes sense? All right, so that's good data. What does it look like as we leap from 23 to 24? Well, I think the secular bull market appears to be marching straight into the next year with the expectation that we will exceed the SPX, just so you know, is the S&P 500, of 47.9656. We are fully invested at this time for that to occur in early 2024. I've had two people, I think, not three, two people say, okay, so you're going to predict on the show whether we're going to hit this new lifetime high this year or next year? I will. I didn't like the action that I saw at the end of today, but I'm going to give it about a 60% chance that we will not hit a new high this year. And I hope I'm wrong, all right? But we will hit a new high sometime in January because this Santa Claus effect, or whatever you want to call it, leads into, we have a very strong period of the market up until about January 27th. At least historically, I'll be talking about that again at the next show. So come back for that. You guys have seen this chart. You know that for the preponderance of time, secular bear markets are shorter than secular bull markets. You see the blue arrow there. We've had that little correction. You kind of have to lean in and squint, but that's where it is. We are turning back up, and I still believe we are about halfway, maybe a tiny bit more than halfway through this secular bull market, which should last into the early 2030s. All right. We also are in a favorable time, pre-election year. So 1983 to 2019, this is just comparing that. We don't know where 2023 is going to end up, but this end of the year so far in a pre-election year, remember 2024 is the election year, really looks good. So that's another factor. This is historical data. I try to show you technical data, but also show you what I call historical patterns. All right, that give us an indication that if the market behaves similarly to how it has done in the past, that we should see a favorable return here over the next several weeks, again, in through the end of January or close to the end. You can look back here at the percentage change for each month going all the way back to 1928. What are the strongest three gaining months? October, November, December. November was really strong, a lot stronger than 0.9%. All right, and December, we'll see. We're halfway there, but this definitely could finish significantly higher. And if so, it will make a new high this year. Now, will that new high hold if we go into, the time between Christmas and New Year's? I don't know. We'll find out, guys. So what am I seeing for next year? Large cap growth outperform mid cap and small cap this year, thanks to positive investor sentiment and the surge of generative AI. So I'm not going to have an AI segment tonight. Go back and watch last month and 2 months before that, where we talk about the power of generative AI. Again, I don't want to go into that right now, but it is the next evolution of AI, if you will, and that's what these big companies are literally falling all over themselves to deliver. And I expect this trend to continue in 2024. Mega cap are also positioned to gain and outperform in 2024 due to the strength of these companies with massive business moats and sustainable competitive advantages. So a moat is what's outside the castle in the 1500s that protects the bad guys from getting in and pillaging the castle there. And the moat, metaphorically in a business sense, means the cost to entry. If you just decide you want to open a discount chain selling all kinds of things and sell a membership to it like Costco does, it would take you 2 to 3 decades to get past their moat, okay? As opposed to the hot dog vendor on the street corner, which is a very, very low moat, all right? But the size of these companies favors them for more success in 2024. 2024. Small and mid caps have an upward battle, but they can succeed. And you saw on the charts earlier that small caps have had a couple great days, but they're 20%, actually probably by now with two back-to-back great days. I'm going to say they're 18, but that's a lot. 18% below the highs, with the Dow hitting two new highs in a row here. So stock picking obviously will be very important for you investors and looking to outperform these segments, which we always are, and after risk management, which is always our top focus. Let me say that on camera. Risk management. That's why we take these stops. Okay, that's why we're protecting your assets, and we have to be careful how we say that. Have to be, all right? Risk management has to be number one, but stock selection and gaining the best risk-adjusted returns is number two. I'm going to breathe for a second here. Looking in the chat box. Hey, Charles, Merry Christmas to you. Hello, Keith, 37K. Yeah, twice. You bet. Mark Burns, good to see you, buddy. Hope you and Rose are well. I know I'm at about a 20-second delay. I'm going to get a sip of water. If you guys have any questions about 23 or 24, shoot them into the chat, and I will respond as soon as possible. This is going to be the longest Fed section I've ever done. Sponsored by Jay Powell. No, just kidding. Just kidding. All right. The Fed. Humble brag. Word of the day. Humble brag. What is a humble brag? An ostensibly modest or self-deprecating statement whose actual purpose is to draw attention to something of which one is proud or even gloating. I'm adding that over and beyond what they say in the dictionary. Okay, yesterday Jay Powell stepped to the microphone, take a few questions, and he had that extra pep in his step. He was so pleased with himself, and his first sentence was all kinds of humble brag. Well, the economy's slowing, we'd help with that, and jobs are gaining, and yeah, it's kind of hard to believe that. I don't know how we did that. Unemployment rate's still low. Well, actually, it ticked up a tenth, Jay, but that's okay. 3.8 still reasonable. Inflation's easing. It has been for a while. Just shucks, man. I don't know how we're doing this. I think we're going to have a soft landing. That's what we've always wanted, and we at the Fed did it. Insert the pat on the back here, okay? So here they are, the big three: Andrew John Bailey, Bank of England; Jay Powell, Chairman of the Federal Reserve; Christine Lagarde, who was on camera today, European Central Bank. These are the big Western powers that are making decisions that affect you and your money and what kind of interest rates you're going to see. So don't try to read all this, okay? Just read the yellow. The huge move in the market yesterday at 1 o'clock Central, 1300 Central, was because the Fed changed two words. Well, actually three, but it's two together. Inflation eased. It used to read last month. So they took the same statement and added has eased. But even more importantly, down below, you see I've highlighted that any. In determining the extent of additional policy, is the way it read last month, in determining the extent of any additional policy, now that is so subtle, but reporters on Bloomberg and CNBC and Fox Business, they were all focusing on that word any. They added the word any. That implies, and everybody had a different take on it. But the reason I'm showing you this is because you saw the earnings and how good they were. The second component in our success is Fed policy. So that's why we spend so much time in the industry, not just me, but all the money managers, trying to figure out what is going on in the Fed's head. All right? Dead Fed's head. Oh gosh, who knows what they're thinking? And they certainly don't want to share it with us because they don't want to roil the market in either direction. But that's what we have to try to determine. And what we know is that after 2 years of behaving as if inflation was all that mattered, the Fed pivoted this week to signal that it would bring in its other mandate, unemployment, back into the equation to set policy moving forward. So what does this mean? The Fed has a double mandate. The Bank of England does not. It's only inflation. All right. And the European Central Bank does not. It is one mandate, and that is inflation. But the Fed, by charter 100 years ago, has a double whammy, has to monitor both employment and inflation. Now, employment at 3.8 is really good. I don't know how they're going to focus on that. Are they going to try to drag that down to 3.4, 3.1? Because that is inflationary to do that. So I don't really know why they're saying that, but the change in policy doesn't rule out a recession, but it certainly makes it less likely. On this news, look at this move in the dollar. I mean, and we trade foreign currencies in Spec Op, and we just had a huge day in the pound, in the Australian dollar, in the euro. And it's because, of course, the dollar plummeted. So we're on the other side of that trade. And then the yields at the same time just fell out of bed. Now, here's the thing about yields. If the yields are going down, does that mean bonds are going up or down? Just the opposite. You guys know that. So bonds moving higher. That's good for fixed income portfolios that have been struggling this year, frankly. All right, so bonds stronger, yields coming down, but it's also good for us that are borrowing money. Good for we that are borrowing money, right? Now, if you are trying to build a retirement on, well, I've got a savings rate of 5.25 now, I should be set. Watch that plummet, okay? Watch that plummet over the next few days, and then even more over the next few months as we talk about the possible, and probable rate reductions in 2024. So the dot plot, I didn't make that up. That's honestly what it's called. The little dots show all the voting members of the Federal Reserve. And you don't have to focus on anything here other than the purple line, which is the Fed Fund futures, and the median, which is the kind of orange line. Both are going down. All right. And they are dropping all the way through 23, which now is about over, but in 24 as well. This is a good thing. Interest rates should drop unless all these Fed governors are misrepresenting what they think. So the important takeaway from Wednesday's Fed decision, all right, what's the most important takeaway? That the Fed pivoted from the expectation of higher interest rates to the expectation of lower interest rates. And some of this I'm going to say twice because I want you guys to settle in. So if you hear me repeating something, it's okay. Just follow it. It's so important that you understand this as investors because it's the Fed and it's those earnings reports that I show you every time too that are so important. So Powell warned of head fakes from inflation, but investors have already been faked out in the past by false promises of shifts from the Fed. Now, Powell has been terrible about this. Janet Yellen didn't have any flip-flops like this. Greenspan was notorious for it because I think he just liked the entertainment factor. Just my opinion. We'll see. I'd like to think that Powell's not doing that. But this time it was a little different. Powell more or less confirmed that officials are done raising rates in this cycle. All right, that's a good thing. Cycle meaning, we're not going any higher until we go down to the lowest point and then we'll go back up again. How long will that take? Nobody knows. All right. So the Federal Reserve officials have penciled in, that's as opposed to writing it in stone or writing it in pen, right? Their words we're penciling in. All right. 3 quarter-point interest rate cuts in 2024 as implied in their latest economic projections. That suggests that 2025 could offer 3 to 4 more 25 basis point cuts in rates in the future. The astute watcher, and I had one person ask me, so before they saw the show, they follow the Fed like I do. So they raised interest rates like 5 times at 75 basis points, right? Yeah. So why don't they just cut 75 basis points for the next 5? Because they would look really silly and have to say, yeah, we were a little too zealous when we did that. This is all Fed psychology. Aren't you guys glad you don't have to deal with this? It's what we do. It's what we have to do. All right. So they're not going to do any 75 basis point cuts. Not going to happen. All right. But all in all, the market got exactly what they wanted. The language used by the Fed indicates they're still open to potential rate hikes. Yeah. If inflation flares up, but we don't see any indication that it is. Otherwise, we're done. And they also indicated that they're now expecting the rate cuts, as I just mentioned, okay? They had previously been saying they were going to cut twice. And then there was at some point where they said they were going to be 4. This is the guessing game. I mean, Wall Street would love to just see the Fed funds rate at 2% tomorrow morning. That's an extreme because it would just blow up. The markets would go limit up and they'd shut down because there'd be so much cash that would have to go into the markets. But the traders do want to see, and I want to see, and you want to see, the lowest interest rates possible, because it means big money says, look, if I can't make money in currencies and getting CDs and whatever else, I've got to go back into the market, and trillions of dollars come flowing in. And the Fed knows that, so they don't drop 75 basis points. I just mentioned this, like they raised it. They just want people to ooze back in, all right? And that's fine. It keeps the VIX low, and it just keeps this chugging along secular bull market moving along, and I like that. So Fed funds futures curve, that's it graphically, just so you can see it. Now you can see it's just dropped significantly from even a week ago, all right? So let's hypothesize. Again, I told you this would be the longest section I've ever done on the Fed. So now that they have made their last interest rate decision, this is a controversial view. Has Chairman Powell done almost everything right? Yeah, maybe. Almost. Many people, and I definitely have been among them for sure, have objected that the Fed was complacent when inflation picked up. Fed officials, he in particular, trivialized with words like, it's just transitory. We don't see a reason to really do much right now. Do you remember that? When we were talking about this last year, mid last year? Egg on your face. He never said that, but it was. Ignoring key inflation warning signs like money supply growth, enormous fiscal stimulus, and waiting too long to hike. And what did that cause? That caused the 75, most parabolic interest rate rises in history. The Fed's only been with us 110 years. So, but what was the alternative? Sure, the Fed could have hiked earlier and faster, but that could have come at a cost to the economy right after rescuing it from COVID. So they were in a tough spot. Ben Bernanke, 2 before, and then Janet Yellen just before, Jay Powell, they didn't have anything close to this. They just didn't. So Powell has had the roughest job really since Greenspan, and Greenspan did before Volcker. So I'm trying to cut him a little slack, although he's landed this plane a lot better than he dealt with the raising of interest rates, all of which, affects us. You know, the Fed has an enormous influence on the economy and therefore on our portfolios and therefore on our lives. And that's why I spent this much time tonight. So there's one more view that the Fed should receive no credit at all. No credit at all. Why? Because of lower energy prices. Now, these comments are coming from futures traders. Crude oil, natural gas have ebbed. So that's the reason inflation has ebbed. Everyone on the planet uses energy of some kind, and most of it, green alert, is fossil fuel. It just is. And when those prices are dropping, it means I can get the same warmth or the same miles driven in my car or the same number of flight miles from Chicago to Miami using that energy for less dollars. You with me on that? And if I have to spend less dollars to go where I was going 3 months ago or 3 years ago, that extra money is called margin, and I can use it on discretionary purchases. That's why energy prices are so powerful and meaningful. So the truth might be that it's a blend of these opposing viewpoints, okay? So here are the bars on Wall Street and LaSalle Street celebrating yesterday when this announcement was made. And I think I put the wrong photo in here. Guys, I thought I researched this. You know what I did? I put the picture of prohibition ending by mistake. I am sorry about that, but the effect is the same. It was 113 years ago, but there was elation everywhere, just like there was back then. I would argue that yesterday's elation was a little bit better purposed. than the prohibition elation, but I digress. All right, I need another sip of water. Let me look in the chat box. And who do I have here? Hey, Martha, how are you? Been here, Charlie? Just couldn't get... Okay, well, we're glad you're here. And Larry, just got home. Good to hear you and see you too. All of you guys, thanks for being here on the last show of 23. I need another sip. You got any questions on that? Here we go into U.S. policy. Do you ever get the feeling we're living in a banana republic? Not that it's appealing, but it sure does feel like a banana republic to me. So why is policy so important? Because politics, which most of us, I think at this point, hate, but politics is necessary to get to policy. And once we get to policy, it needs to be policy that helps us as investors. I am not on the scale of being that concerned about social initiatives at the federal level. I know you guys know that, but I'm stating it again here. I am interested in policy at the federal level. That means Congress, that means the White House, that helps you guys and me as investors. And that has personal impact on our lives. This is not something that's necessarily my opinion, but it came to me from one of our viewers. Is this clever or what? Oil's going to be gone in 10 years. There'll be an ice age in 10 years. That's the 70s. In 1980s, acid rain. There'll be no crops in 10 years. 1990s, the ozone layer will be gone. All of it. Miles and miles and miles of it around the earth. 2000, ice caps will be gone. There'll be no Arctic Circle. None of it happened. But our taxes got raised. Big government wants to be the solution. Reagan said it was the problem, but I digress. It's the political section, but I just wanted to tell you that was what was on this viewer's mind. Here's what's crazy. So the House Republicans have voted to formally authorize, not impeach him, but to explore an inquiry, which means there's going to be testimonies. It means there's going to be subpoenas. Let's see, we've already had a subpoena where Hunter didn't show up, but I digress. It's a circus. But hey, I can't just say it's all on Biden. This is the other circus. 98 charges against the former president. And he's somewhat elated here because it looks like one of the December 6th cases might be put off indefinitely. And of course, he's calling it a big win. It's a shame for all of us. I mean, did any of us think we were going to live in a country where both presidential candidates might be campaigning from a jail cell? I mean, this sounds like Nicaragua. This sounds like Colombia, Albania. No, this is the United States, the most important and powerful country in the world. And it's just crazy. Trump has taken a lead, according to Bloomberg, Morning Consult. I even saw this in the Wall Street Journal poll. Over Biden. We'll see if this happens. Next year, I'll be full of polls here, guys. Every single show will have a pretty beefy political section. It has to, because policy is affected by politics, and policy affects your portfolio, which thus affects your personal life. All right, inflation, short section here. I gathered this is sort of the right-wing side. All right. People that are saying, well, when Trump left office, it was 1.6%. Look at all this inflation. Well, okay. There's some truth to that. Electricity up 26%. Have you guys gone to the grocery? You know what I've seen more than anything? I mentioned this to somebody the other day. We were eating at a restaurant we ate at 2 years ago, and it's like, is this portion the same as what we got? Or is this sandwich like a finger food? Because it's the same price. Maybe they're trying to keep people there. But the sandwich is shrunk, all right? And there's maybe 2 less pickles on it or something. I don't know. I'm laughing because I guess there's various ways for these vendors to try to combat inflation, but they're facing it at the vendor level, just like we are at the consumer level. But despite the right side saying inflation, 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 Biden's killing us. Okay, well, but this is the chart. And yes, 5.25% is terrible, and it's very, very, very slowly coming down, and that is because of policy, and a lot of that is energy policy. Guys, it's unavoidable that I discuss this. We need to be strong in energy. We need to be energy independent and an exporter of energy. It changes everything in the world dynamic and essentially neuters, strong word, neuters OPEC. And that's to our advantage. So that's what's going on in inflation. You can see both sides of it. Yes, it's much higher than it was 3 years ago, but in the last year or so, look at the dates, we are slowly coming down. And the humble brag from Jay Powell would be that the Fed is responsible for that. You be the judge. All right. So the consumer price index is similar to what's happening in the inflation index, but the consumer price index is reflected in what prices are. You don't need to remember anything on this chart other than it's going down from mid-2022. And that's a good thing. It's going down. We want to see that. Just a couple economic indicators that I found interesting. Consumer spending, core consumer spending. All right, so excluding autos, gas, and building supplies. Wow, it's beyond solid. It's really, really strong. Pre-COVID trend, it's exceeded the pre-COVID trend. There's that big V recovery there you can see, all right, in 2020. I mean, the American consumer is strong. So what's the downside, Charles? That credit card balances are increasing again. So how much of that new spending is being put on credit cards? Oh, it would be great to be able to monitor that. Do not have that data for you yet. I'm hoping to have a year-end total for you probably on the February show. It takes that long a time to accumulate that kind of data. But that's what we're hoping to see. And anyway, that's where we are. Great spending, but it's going on credit. Not necessarily good. And from Mark, I don't think prices will go down. Well, if prices were to go too far down, Mark, and it's a good point, we could risk deflation or stagflation. I've covered those terms in previous shows. I'll probably do it again in January. So a little bit of inflation is good. In fact, the Fed's target, anybody know? I won't wait for you to type it in the chat. 2%, all right? It's 2.5% Bank of England, I believe, right? And then 2.5% for the Eurozone too. But 2% is the Fed's target. 30 years ago, it was 3%. And then I think they realized, we had some problems with that. Let's just make it 2%. But it's not 1%. When Trump left office, it was about 1.8. So it was a little under the target. And obviously it's gone crazy since then. So housing market, this is not a great data. I mean, so the share of residential investment as a portion of GDP just continues to drop here. It's not quite back where it was in 2010, but remember 2010 was just coming off the huge financial crash of 2008, 2009. All right. Buying conditions for homes, like just falling off the chart here, meaning it's better to rent. And that's actually the focus of what I'm talking about today. So U.S. existing home sales, not quite as low as September 10, but again, September 2010, we're just coming out of the worst financial crisis in our country's history since the Great Depression. No, it was not COVID. That was the fastest, but the deepest, which is of much more concern than the fastest, was 2008, 2009, and the aftermath in 2010. Okay, so what this is doing is it means it's a lot more expensive to buy a home than to rent one. Now, the Federal Reserve saying that we've stopped the interest rate increases is going to help this ebb. So I'm going to watch this for next month. Definitely in February, I'll put this back up here, and I'm betting that ratio closes. But for right now, if you got to buy or rent, it sure is cheaper to rent. And in fact, you're seeing in articles that I'm reading, a lot of, even with interest rates coming down, there's just a surge of retail housing out there hitting the market. And the high cost of ownership just makes it tough for the American dream right now. It just really does. So let's see. Or is it just peeling? That's from Andre. Help me out here. What's peeling? Oh, yeah. You got it. You're playing off my bad joke. Very good. All right. And I saw Mark say about the prices going down. Yeah, I think we're going to still have inflation concerns for a while, but it is moving in the right direction. And again, slow is better than dramatic. Which is why, even though it sounds like it would be fun or nice to have the Fed funds rate drop 3/4 of a percentage point or 75 basis points like 5 times in a row. No, we don't want that. We really don't. So, all right. Cost of renting versus owning is just real easy to see on the chart. It's just skyrocketed here in 2023 in favor of leasing. So the red line is the new home payment. So this is a chart where you want the lines to be lower, not higher. Okay. So this one's on here just for fun, guys. What are the odds of a white Christmas? Cue the music with Perry Como. I will not sing it, but you can hear it in your head, right? So they always had snow up there in New Hampshire during White Christmas, Bing Crosby, the whole crew. So if you are in Marquette, Michigan, for our Michigan fans, 96% chance of snow since 1948. 70 of them have had snow. Last year, 18 inches. Okay, if you're in Louisville, probably not going to happen. Chicago, where I am, a little less than 50% actually. So I'm not going to say this is global warming or anything like that. But at any rate, there you go. Find your nearest city and take it in from there. So I have this tradition of playing this video because it strikes at my heart, and you'll see why if you haven't seen the video. If you have, you know it's an annual tradition. But it's a season of giving. Obviously, for those of us that have a Christian faith, it's about much more than that. But a season of giving, a season of being kind. And I found this video some years ago, and it's a story about a little boy who wasn't treated very kindly and really struggled with self-image. And as you will see, it spoke to me in a very special way, and I hope it does the same for you. I like to think that all of us have potentials that we can reach beyond where we are right now when we think of a story like this. This Christmas season, reach out to someone that may be struggling and share some enthusiasm and affirmation with them and encouragement. Encouragement is such an important quality, and I try to do that on these programs. I hope that I've done that this past year for you. We start our 5th year in March of next year of doing these CB3 Lives, and it's just my honor to do it. So these are our topics, and we cover just a few tonight, but normally we'll cover more of them. We'll do that in January, but tonight I just really wanted to focus on those areas. The next program, Thursday, January 11th, we think we're going to have a fireside chat that night. We might have a scheduling issue that just kind of crept up here, but for now, put it on your calendar, Thursday, January 11th. January 11th, okay? And it should be a live fireside chat. You'll know more. Watch your mail and watch your email for that. And just remember the reason for the season and the little people here in your life. I give thanks for them. In case any of you ever wondered, Charlie Brown was born in 1950. That was the first comic strip. I was born in 1955. He's actually older than I am. He has aged better, I will say, though, than I have, okay? We'll mix it up here at the end rather than the Timothy quote. May the God of hope fill you with peace as you trust in him. Romans 15:13. It's been a fun year for me. It's been an exciting year. We started these programs in Nashville. We are now back in Chicago to stay. We've been here. We continue to be here, CB3 at CB3.com. We answer your questions. We manage money for you, those that are clients. We appreciate your business. We never take it for granted. We will see you in 2024. Those of you that just watch the program and enjoy the banter, so to speak, we love you guys too, okay? We need all of that in our growing community. Tell someone that you know that might be scared about their financial future and maybe went to cash because they were just scared in September, and look at what they would have missed. I mean, all cash and stayed there. I know that happened in 2008 and 9. It took them till 2011 to get back in. All right, so that's why we exist here at CB3 Financial. At CB3 Financial, we don't just manage your assets. We become one of them. We want to become that for you again in 2024. May God bless you and your family. Have the merriest of Christmas and holidays and New Year's. We will see you on January 11th. And until then, take great care of yourselves.